Welcome to the deep dive. Today we're getting into something called algorithmic trading.
Right.
Basically, it's using computer programs, these algorithms, to, well, make and execute trades for you.
Yeah, automatically.
Exactly. Now, traditional trading, that's a human making the calls.
Yeah.
But these algorithmic systems, they can juggle tons of strategies, different markets all at once.
Mm-hmm. Much faster than a person could.
Oh, way faster.
Yeah.
They spot opportunities and act on them like lightning. So think of this as your shortcut to understanding a pretty complex field and, its huge impact on finance.
Definitely. And for this deep dive, we're mainly drawing from Algorithmic Trading Technical Guide.pdf. Our mission really is to pull out the key ideas, the benefits, the challenges, and the tech behind it all.
It's a field that's changed so much, hasn't it?
Absolutely. Incredible transformations.
Yeah, because it wasn't always this super high-speed thing we see today. If you go back to the 80s,
Right.
you had the beginnings with something called program trading.
Program trading, yeah. What was that mainly for?
Mostly for handling really big stock trades electronically. Often for things like index arbitrage, exploiting tiny price differences.
Ah, okay. So it was driven by just the sheer size of the trades. Humans couldn't really click the buttons fast enough or accurately enough.
Pretty much.
Mm.
Handling that kind of volume manually was, inefficient.
Makes sense. Then the 90s came along.
Right. And then we got these electronic communication networks, ECNs. How do they shift things?
ECNs, yeah. They were a big step. They essentially created more direct links between buyers and sellers, cut out some of the traditional go-betweens.
Like a digital marketplace.
Exactly. A digital marketplace, you could trade more directly. This meant, faster trades, better efficiency, and it kind of opened up the markets more.
Okay. And then the 2000s.
Yeah.
That's when things really took off, right? High-frequency trading boom.
Oh, yeah. The 2000s were the acceleration point. Technology was just exploding.
What specifically? Computing power.
Computing power, yeah. Massive leaps. Data storage got way cheaper and bigger. And network speeds, just incredibly fast. That combination allowed for algorithms that could react to market shifts in, tiny fractions of a second.
Milliseconds, microseconds even. It's like Formula One, but for finance.
Good analogy. And that speed relies heavily on the underlying tech.
Like the internet itself, the pipes.
Absolutely critical.
Mm-hmm.
High-speed internet is the backbone. You need that rapid data flow, that low-latency execution, especially if you're trading globally. Every millisecond is vital.
It's not just the speed of the connection, though. It's the amount of data flowing, isn't it?
Right. It's a flood. Market data, news feeds, even what they call alternative data. Algorithms can process all of that.
Way faster than we can.
Oh, orders of magnitude faster.
Mm-hmm.
Sifting through it, looking for patterns, signals, things a human might just completely miss.
And you need the right tools to handle all that data and, actually make the trades.
For sure. That's where specialized software platforms come in. And specific programming languages designed just for building and running these trading bots. It's become a very specialized skill set.
Now, with things changing so fast, the regulators must have been playing catch-up, right? It's not the Wild West out there.
Definitely not. Regulation has evolved right alongside the technology, often in response to specific events, actually.
Like the flash crash, 2010.
Exactly like the flash crash. That was a huge wake-up call. It showed how quickly automated systems could spiral, and it spurred a lot of regulatory changes to try and prevent that happening again.
Okay, so what kind of changes came out of that? What did regulators focus on?
A much bigger emphasis on risk management. Things like pre-trade controls.
Checks before the trade goes through.
Yeah, basically sanity checks to stop an algorithm going rogue. And till switches, a big red button to shut down a problematic system quickly.
Right.
And market-wide circuit breakers, too. If the whole market goes crazy volatile, they can pause trading for a bit. Safety valves, essentially.
Crucial safeguards, seems like. What about transparency? Making sure people know what's happening.
That improved, too. Requirements for real-time trade reporting became stricter, so everyone gets a clearer picture of market activity. Plus, detailed audit trails.
Audit trails?
Yeah, tracking every single action an algorithm takes helps regulators investigate if something looks fishy.
And the systems themselves.
Right.
They need to be solid, right? Can't have them crashing mid-trade.
Precisely. So there's more focus now on system resilience. That means rigorous testing, validation, making sure these things actually work reliably, and having solid business continuity plans if, disaster strikes.
Like backup systems.
Backup systems, data recovery, the whole 9 yards. The infrastructure has to be dependable.
And since markets are global, you can't just have totally different rules everywhere, can you?
Good point. There's been a big push for global coordination, regulatory bodies talking to each other, trying to harmonize the rules, share information. It's pretty essential when money's flying around the world that fast.
Okay, makes sense. Let's dig into the pros and cons then. What are the big advantages of using algorithms for trading? For traders, for the markets overall?
Well, one of the biggest ones is probably lower transaction costs.
How does that work?
Automation just makes the whole process more efficient. It can lead to lower brokerage fees, tighter spreads between buying and selling prices. It saves money.
Okay, that's a clear benefit. What else?
Improved liquidity, that's a key one.
Meaning it's easier to buy and sell.
Exactly. Algorithms can be programmed to constantly offer to buy and sell, effectively narrowing that gap, the spread. That makes the market smoother, makes it easier for everyone to trade when they want to.
Smoother functioning markets. Got it.
And then there's the obvious one, speed and efficiency, reacting in milliseconds. Humans just can't compete on that level. It's crucial for grabbing those fleeting opportunities.
And that speed probably helps with getting the exact price you want too. Precision.
Absolutely. Algorithms execute trades with incredible precision and consistency. They follow the rules, no hesitation, no second guessing, no emotion. That often leads to better execution quality overall.
Right. No fat finger errors, or fewer of them anyway.
Hopefully fewer. And think about access. Algorithms can trade across different exchanges, different countries, different time zones, all simultaneously.
So, true global reach, 247.
Pretty much, yeah. Opens up markets that might have been hard to reach before.
And you mentioned emotion. Taking the human gut feeling, the fear and greed out of it. That must be a benefit sometimes.
It often leads to more disciplined trading. The algorithm sticks to the plan, it doesn't panic sell or get overexcited. That can really help long-term performance.
Discipline. And what about those tiny, super quick price differences? Arbitrage.
Perfect for algorithms. They can spot those tiny discrepancies across different markets or related products, things a human trader would almost certainly miss and act on them instantly.
Okay, so lots of potential upsides. But it's not all smooth sailing. What are the main risks, the downsides, the limitations here?
Well, the big one is technical glitches, software bugs, system failures.
Like Night Capital, that was huge.
Exactly. Night Capital in 2012 is the cautionary tale. A software error cost them hundreds of millions in 45 minutes. Shows these systems aren't infallible. Scary stuff.
Very sobering. What else? Market impact.
Yeah, algorithms can sometimes actually amplify market volatility. The flash crash, again. It showed how lots of algorithms reacting to each other can create these sudden, drastic price dives.
So they can feed off each other in a bad way.
Potentially, yeah. Liquidity can suddenly dry up. Different algorithms might interact in unexpected ways. It can get complex and unstable fast.
The machine's creating instability unintentionally. That's a worry.
It is. And beyond the big systemic risks, there are practical hurdles. Building and maintaining these systems. It's expensive.
You need the tech, the infrastructure, the smart people.
Exactly. Serious investment needed. That's a barrier for smaller players. Then there's model risk.
Model risk, meaning the strategy itself might be flawed.
Or it might just stop working. A model developed on past data might not hold up when market conditions change. The market's always evolving. Models can become outdated.
So what worked yesterday might fail tomorrow.
Precisely. And competition is fierce. Lots of smart people, lots of sophisticated firms are in this space now, so finding a real edge gets harder and harder.
Makes sense.
And finally, everything depends on data. Good data. If the data feeding the algorithm is wrong, delayed, or incomplete, garbage in, garbage out.
Right. The decisions are only as good as the input. So, powerful tool, huge potential, but needs really careful handling and a realistic view of the limits. Okay, let's shift focus slightly. Talk about the playground these algorithms operate in.
Yeah.
What do the global financial markets look like for an algo trader?
It's a massive landscape. You've got equity markets first, that's stocks, shares, and companies. Pretty straightforward.
Yep.
Then fixed income markets. That's all about debt, government bonds, corporate bonds, stuff like that.
Okay.
Bonds. And the big one, foreign exchange market, Forex, trading currencies, URUSD, GBPUSD, all those pairs. It's enormous and runs 245.
Huge volume there.
Absolutely massive. Essential for global trade. Then you have derivatives markets.
Derivatives. Options, futures.
Exactly. Options, futures, swaps, forwards, contracts whose value is derived from something else, like a stock or a commodity.
Okay. And commodities themselves?
Yep. Commodities markets, trading things like gold, silver, crude oil, natural gas, even agricultural products like corn and wheat.
Wow. Okay. Anything else?
And money markets, too, for very short-term debt. So yeah, it's a really diverse, interconnected system.
Definitely interconnected.
Yeah.
And who are the main players in these markets? Who do the algorithms interact with?
All sorts. You have the big institutional investors, pension funds, hedge funds, mutual funds.
Big money.
Right. Then retail traders, that's individuals like you and me, maybe trading through an online broker. You've got market makers and liquidity providers. Their job is basically to stand ready to buy and sell to facilitate trading. Brokers and dealers who execute trades for clients.
Okay.
And overseeing it all, the regulatory bodies and the exchanges themselves, the NYSE, the LSE, etc., providing the infrastructure and the rule book. Understanding who's doing what helps predict how the market might move.
Makes sense. So where does the actual trading happen? These exchanges, ECNs?
Multiple places. The traditional stock exchanges are still major venues, of course.
Like the New York Stock Exchange.
Right. Then you have the electronic communication networks, ECNs we mentioned. They directly match buyers and sellers electronically, often anonymous, quite transparent on pricing.
Okay.
There are also alternative trading systems, ATSs. That category includes things like dark pools.
Dark pools. Sounds mysterious.
A bit. They're basically private platforms, often used by institutions to trade large blocks of shares without revealing their intentions to the wider market immediately. Less price impact, maybe, but less transparency, too. And finally, over-the-counter, or OTC markets. These aren't centralized exchanges. It's more like a network where participants trade directly with each other, often for things like bonds or complex derivatives. Algo traders need to know the pros and cons of each venue.
Yeah, sounds like choosing where to trade is part of the strategy itself. Okay, let's get into the nitty-gritty, the mechanics. Market microstructure. What's important there for algorithms?
Microstructure is all about how trading actually works on a moment-to-moment basis. How the venues operate, the order entry systems, the matching engines.
Matching engines, the things that pair up buy and sell orders.
Exactly. Usually based on price priority, best price goes first, and then time priority, first come, first served at the same price. Understanding that logic is key. Also, how trades are cleared and settled the whole post-trade process. And of course, the specific rules of that market. Algorithms have to play within those rules.
Right. And placing orders isn't just buy or sell, is it? There are different types. And this order book...
Exactly. The order book is crucial. It's the live electronic list of all the current buy orders, bids, and sell orders, asks for a specific stock or asset, ranked by price. It shows you the supply and demand right now, the depth of the market.
Okay, so you see the prices people are willing to pay and accept.
Yep. And the order types determine how your order interacts with that book. A market order just takes the best available price right now. A limit order lets you specify the exact price you'll accept.
So you might not get filled immediately with a limit order.
Correct. Then you have stop orders, often used for risk management, like a stop loss. And more complex types, too. Knowing how these orders behave is fundamental for algorithmic execution.
Got it. And markets aren't open 24/7 usually, and even during the day, things change. Trading sessions.
Right. Most markets have distinct phases. There's usually a pre-market session, then an opening auction to set the initial prices, then the main continuous trading session, often a closing auction, and sometimes a post-market session.
And liquidity is different in those phases.
Oh, yeah. Liquidity and volatility can vary a lot. Pre-market might be thin. The open can be volatile. Algorithms need to adapt their behavior based on the market phase. You wouldn't trade the same way in the pre-market as you would midday.
Makes sense. Adjusting tactics. And ultimately, how do crises actually emerge from all this activity?
Well, fundamentally, it's supply and demand. But on a micro level, it's driven by the flow of those orders hitting the order book. New information comes in news, earnings reports, whatever people react, place orders, and that shifts the balance of bids and asks, moving the price. How efficiently that information gets reflected in the price is a measure of market efficiency.
Okay, so it's this constant dynamic process of orders and information leading to price discovery. Right, with that market context, let's dive into the engine room, the math and stats. This sounds like where it gets heavy.
It can be quite quantitative, yeah. Probability and statistics are the bedrock. You absolutely need to understand things like random variables, quantities that can change, like a stock price, and their probability distributions.
Distributions telling you how likely different prices are.
Exactly. That helps model the uncertainty inherent in markets. Then you need descriptive stats, mean, standard deviation.
Average price, how much it tends to wiggle around.
Right. Standard deviation gives you a measure of volatility. And concepts like skewness and kurtosis tell you more about the shape of that distribution, like, are extreme price jumps more likely than a normal bell curve would suggest? which they often are in finance.
Okay, so painting a statistical picture. What's next? Inferential stats.
Yep, inferential statistics, that's where you use sample data to draw broader conclusions. Hypothesis testing is huge here.
Testing if a trading idea actually works.
Basically, yes.
Yeah.
It's a formal way to test a theory. You set up a null hypothesis, like this strategy has no edge, it's just luck. And then you look at the data to see if there's strong enough evidence to reject that null hypothesis and conclude the strategy might actually work.
So trying to separate skill from luck, statistically.
That's a good way to put it. Then there's time series analysis. Financial data is a time series, prices ordered chronologically, so you need tools to analyze that.
Looking for trends, seasonality.
Trend seasonality cycles, yes. Financial time series have weird properties too. They're often non-stationary. Volatility comes in clusters.
Yeah.
So you need specialized models like AREMA or DOR-CH to handle that properly.
Right, specialized tools for time-based data. And then there are specific quantitative finance models.
Yes, building on the stats. Stochastic processes like Brownian motion are used to model how prices might evolve randomly over time. Option pricing models like the famous Black-Scholes equation.
Heard of that one?
Yeah, it's fundamental for derivatives. And portfolio theory ideas like diversification, the efficient frontier, the capital asset pricing model, or CAPM. These help you think about balancing risk and return across multiple assets.
Managing risk across a portfolio.
Exactly. And specific risk measures too, like value at risk or VAR, which tries to estimate potential losses under certain conditions. So yeah, a strong quantitative foundation is pretty much non-negotiable.
Definitely sounds like it. Okay, let's pivot from the math theory to the actual application. The trading strategies themselves. Where do we even begin? There must be hundreds.
Oh, loads. But they often fall into broader categories. A really big one is technical analysis.
Chart patterns, indicators, that stuff.
Exactly that stuff. Using historical price and volume data to find patterns, predict future movements, generate trading signals.
Okay, like trend following.
Trend following is a classic technical strategy. The goal is simple. Identify if the market is trending up or down, and ride that trend. Moving averages are a common tool here, calculating the average price over a certain period.
Simple moving average, exponential moving average.
Right. And looking for when a short-term average crosses over a long-term average, that can be a signal to buy or sell.
Okay, relatively straightforward concept. What else in the technical toolkit?
Momentum indicators are popular. They measure the speed and strength of price changes. The idea is that strong moves might continue. RSI, Relative Strength Index, is one you hear a lot about.
RSI, MAT.
MAT, yeah. Moving average, convergence, divergence. They help gauge if a market might be overbought or oversold. And then you have strategies based on volatility itself.
Trading the choppiness.
Kind of, using indicators like Bollinger Bands, which plot bands above and below moving average based on standard deviation, or strategies that look for breakouts when volatility increases, maybe using something like the average true range, ATR.
Okay, so technical analysis is very price action focused. What's a different philosophy?
Mean reversion is another major category, totally different idea.
The opposite of trend following almost.
In a way, yeah. It's based on the assumption that prices, while they fluctuate, tend to eventually revert back to their historical average or mean.
So if a stock shoots way up, a mean reversion strategy might bet on it coming back down.
Exactly. Or if it drops sharply, bet on a rebound. Statistical tools, oscillators like the stochastic oscillator, or even RSI again, can be used to spot these potential extremes. Pairs trading is a well-known example.
Pairs trading.
Yeah, finding two assets, maybe two stocks in the same sector that usually move together. If their prices diverge significantly, you bet on them converging again. You'd short the one that went up and buy the one that went down. Requires statistical concepts like co-integration.
Okay, that sounds more statistical. What about exploiting those really tiny, fleeting price differences?
That's statistical arbitrage, or stat-arb. This gets much more complex. Using sophisticated mathematical models to find tiny temporary mispricings between related assets.
Like a stock and an ETF that holds it.
Could be. Or different share classes of the same company. Or between a stock and its futures contract. These discrepancies usually only last for fractions of a second, so you need very fast execution.
Which brings us to high-frequency trading, HFT, that uses stat-arb sometimes.
Often, yes, but HFT is really defined by its speed, executing huge numbers of orders at incredibly high speeds. Latency delay is the enemy. Everything is optimized for speed. Co-locating servers right next to the exchange's servers, specialized hardware.
What kind of strategies do they run at that speed?
Things like exploiting tiny differences in the order book itself, super fast stat arb, reacting instantly to news releases like economic data milliseconds after it hits the wire. It's a technological arms race.
Wow. Okay. What about using news more broadly, or sentiment?
Yeah, that's another growing area. News and sentiment-based trading, using natural language processing, NLP, to analyze news articles, tweets, financial reports.
Trying to gauge the mood of the market?
Essentially, yeah. Quantifying sentiment, positive, negative, neutral, and trading based on shifts in that sentiment or specific news catalysts.
Fascinating. And the really cutting-edge stuff now involves machine learning, AI.
Definitely. Machine learning strategies are becoming much more common. You can use supervised learning training models on historical data to predict future prices or classify market conditions.
Like regression or classification models.
Exactly. Or unsupervised learning to find hidden patterns or clusters in data without predefined labels. Think anomaly detection or dimensionality reduction.
And reinforcement learning, training an agent to learn by doing.
Right. Reinforcement learning agents can learn trading policies through trial and error in simulated environments, aiming to maximize rewards over time. And deep learning, using complex neural networks, is being applied for really intricate pattern recognition tasks.
So a huge spectrum of strategies, from simple rules to complex AI. All of this, though, needs the right technology powering it. Let's talk infrastructure. What's the foundation?
Well, you need the trading platforms and execution systems first. That's your connection to the market. ECNs, as we mentioned, are key digital venues.
And for the absolute lowest latency, direct market access, DMA.
Exactly. DMA lets your algorithm send orders straight to the exchange's matching engine, bypassing some intermediaries. Crucial for HFT. Brokers provide platforms too, and critically, they offer API connectivity.
APIs, the interfaces that let the algorithms talk to the broker systems.
Precisely. Application programming interfaces, often using standard protocols like FIXIX, Financial Information Exchange, or maybe REST APIs. That's how your code gets data and sends orders automatically. FIC is a huge industry standard for this communication.
Okay, so that's the connection. What about the code itself, the languages people use?
It varies. Python has become incredibly popular, especially for research, backtesting, and less latency-sensitive strategies. It has amazing libraries like Pandas, NumPy, scikit-learn.
Easy to use, big community.
Right. But for the really high-performance stuff, the core execution engines, where every microsecond counts, C++ is still king. It gives you fine-grained control over memory and performance. Java is also widely used, especially in larger banks, for its platform independence and scalability.
So different tools for different jobs within the system. And all this software runs on hardware. What matters there?
Speed and reliability. Fast processors, CPUs, lots of RAM, really fast storage like SSDs, and specialized low-latency network interface cards, NICs, and location matters.
Co-location, being physically close to the exchange.
Yep. Putting your servers in the same data center as the exchange's matching engine drastically cuts down network travel time for data and orders. Essential for HFT. You also need robust networking gear switches, routers.
And handling the sheer volume of market data that requires serious processing.
Oh, yeah. You use techniques like multi-threading, doing multiple things at once within your code, and parallel computing. Sometimes even specialized hardware accelerators like FPGAs are used for specific, highly repetitive tasks. In-memory databases can also help by keeping critical data instantly accessible in RAM.
FPGAs,
Yeah.
field programmable gate arrays, like custom chips.
Kind of. You can program them at the hardware level for extreme speed on certain calculations, very specialized stuff.
What about the cloud? Is algorithmic trading moving to the cloud?
It's a mixed bag. The cloud offers great scalability and flexibility for things like research, data storage, maybe backtesting. You can spin up huge computing resources easily.
But for the live, ultra-low latency trading?
For that critical execution path, many firms still prefer co-location or dedicated infrastructure for maximum control and minimal delay. But cloud security and compliance have improved a lot, so its role is growing, maybe more for less latency-sensitive strategies or supporting functions.
Balancing act.
Yeah.
And the software itself needs structure, right? Architecture.
Absolutely. You don't just write one giant program. Good systems use modular design, maybe an event-driven architecture, where components react to incoming data or events. Service-oriented architecture, SOA, is common too, breaking things into reusable services like a market data service, a strategy service, an order routing service. Design patterns help ensure the code is scalable, maintainable, reliable.
Building a robust, well-oiled machine, not just writing code. Okay, now, none of this works without data, good data, Let's talk data management. Where does it all come from?
Multiple places. Real-time market data feeds are essential. Level 1, Best Buy Ask. Level 2, deeper order book view. Tick data, every single trade. You get this directly from exchanges or via vendors like Bloomberg, Refinitiv, or specialized API providers.
Oh, the live pulse of the market.
Exactly. Then you need historical data for backtesting and model training. Vendors supply this to end-of-day prices, intraday bars, or even historical tick data.
And alternative data that's getting bigger.
Yeah. Huge growth area. This is non-traditional data that might have predictive value. Think satellite imagery of oil tankers, credit card transaction data, web scrape news sentiment, social media trends, even geolocation data.
Wow. But getting and using that data must have strings attached. Licensing.
Oh, absolutely. Data licensing can be complex and expensive. And you have to worry about compliance usage rights, privacy regulations like GDPR or CCPA, especially with alternative data. It's not just grab and go.
Okay. And once you have the data, it's probably messy.
Almost always. Raw data needs cleaning and pre-processing. Handling missing values, dealing with outliers or errors, adjusting for things like stock splits or dividends, normalizing data so different sources are comparable.
Yeah.
It's a critical, often time-consuming step.
Feature engineering, too.
Yeah.
Creating useful inputs from raw data.
Yes, that's super important. Transforming raw data, combining variables, creating new indicators that can make a huge difference to model performance. It's part art, part science.
And with these massive data sets, especially alternative data, you need special tools. Big data tech.
For sure. Technologies originally developed for web companies are now common in finance. Distributed file systems like HDFS for storing huge data sets across many machines. Distributed computing frameworks like Apache Spark for processing it in parallel. Stream processing engines like Kafka or Flink for handling real-time data feeds. And NoSQL databases for flexible data storage.
So borrowing tools from the tech world, how do you make sense of it all? Visualization.
Visualization is key for exploration and understanding. Plotting price charts, performance curves, correlations. Libraries like Matplotlib or Seaborn in Python are common. Interactive dashboards using tools like Tableau or Power BI help monitor things in real time.
Seeing the patterns and storing it all securely and efficiently.
Right. Different database types suit different needs. Traditional relational databases, SQL, for structured data. Specialized time series databases like KDB Plus or InfluxDB are optimized for time-stamped financial data. Data warehouses consolidate data for analysis. And underlying all this is data governance, assuring data quality, security, access control, backups, disaster recovery. It's a massive operational challenge.
Definitely a whole discipline there. Okay, we touched on machine learning strategies, but let's zoom in on ML and AI in trading. What are the fundamental concepts people need to grasp?
Well, at its core, machine learning is about algorithms learning patterns from data. The typical workflow involves getting data, cleaning it, training a model, evaluating it, and deploying it. Key theoretical ideas include the bias variance, trade-off balancing model simplicity and complexity, and avoiding overfitting.
Overfitting, where the model learns the training data too well, including the noise.
Exactly. It performs great on the data it saw during training, but fails miserably on new, unseen data. Regularization techniques help prevent that.
Okay. So what are the main types of ML used? Supervised learning.
Supervised learning is very common. I've labeled data like historical prices labeled with whether the price went up or down afterwards. Regression models predict a continuous value, like future price. Classification models predict a category, like buy, sell, hold. Lots of algorithms here. Linear regression, support vector machines, SVMs, decision trees, and powerful ensemble methods.
Ensemble methods. Combining multiple models.
Yeah, like random forests or gradient boosting machines like XGBoost or LightGBM. They often perform better than single models.
Okay. And unsupervised learning. No labels.
Right. Here the algorithm finds structure on its own. Clustering algorithms, like k-means, can group similar assets or market regimes together. Dimensionality reduction techniques, like PCA, can simplify complex data sets by finding the most important underlying factors, useful for uncovering hidden patterns.
Finding structure you didn't know was there. What about deep learning? Neural networks.
Deep learning uses neural networks with multiple layers to learn very complex hierarchical patterns. Convolutional neural networks, CNNs, originally from image recognition, can find patterns in chart-like data. Recurrent neural networks, RNNs, including LSTMs and GRUs, are good for sequential data like time series. Autoencoders can be used for feature extraction or anomaly detection. Very powerful, but also data-hungry and complex.
Needs lots of data and computing power.
Definitely. And we mentioned NLP, natural language processing. That's crucial for sentiment analysis.
turning text into tradable signals.
Pretty much. Techniques like TF-IDF or word embeddings represent text numerically. Sentiment models classify text as positive, negative. Topic modeling finds themes. Processing news in real time is key here.
And reinforcement learning, the learning by doing approach.
Yeah, RL is exciting. An agent learns a policy, a strategy for taking actions like buy, sell, hold in different market states by getting rewards or penalties based on its performance in a simulated environment. Deep reinforcement learning combines RL with neural networks. Still quite research-heavy, but holds a lot of promise for adaptive strategies.
So once you've trained a model, supervised, unsupervised, whatever, how do you actually use it? Deployment.
Deployment is getting the model out of the lab and into the live trading system. Can be done in batches or in real time. Strategies like A/B testing, comparing models, or shadow deployment, running a new model alongside the old one without trading on it help manage risk. And monitoring is critical.
Watching to see if it still works.
Exactly. You need to monitor its performance metrics, detect model drift when the model's predictions start degrading because the market has changed. And ethical considerations are vital too, especially around fairness and potential biases in the algorithms.
Right. Ensuring the AI isn't making biased decisions. Okay, so that's the ML angle. Let's get really practical now. How do you actually build a trading algorithm step by step?
It starts with the idea. First, define your objectives clearly. What are you trying to achieve? Capital growth, income, risk reduction, what markets, what time frame.
Setting the goals.
Then develop the trading idea itself. This could come from market research, spotting a pattern, technical analysis, quantitative analysis, maybe an economic theory.
A spark of the strategy.
Right. Then you have to translate that idea into a precise, unambiguous set of rules, the algorithm specification. This might involve mathematical formulas, pseudocode. What are the exact entry conditions, exit conditions, position sizing rules?
Getting really specific.
Absolutely specific. Then you choose your tools, programming language, libraries, and actually code the algorithm based on that spec. And you need to identify risks and constraints upfront. How much capital do you have? What are the leverage limits? Regulatory restrictions.
Thinking of the practical limits. Okay, so you've coded the core logic. Where does that fit into the overall trading system?
The algorithm is just one piece, usually the strategy engine. The full system needs modules for acquiring data, market data, news feeds, processing and storing that data, the strategy engine generating the buy-sell signals, an order execution module to actually send orders to the broker or exchange, and a crucial risk management module.
Risk management, watching over everything.
Yeah, checking position sizes, calculating risk metrics, maybe enforcing stop losses before orders even go out, pre-trade risk, and monitoring overall portfolio risk post-trade. Then there's the infrastructure layer servers, networks, connectivity, and monitoring and alerting for performance, errors, risk breaches.
Lots of moving parts. How do you design it so it doesn't become a tangled mess?
Modular design is key. Break it down into logical, independent components with clear responsibilities and interfaces. Aim for high cohesion within modules, they do one thing well, and low coupling between modules. They don't depend too much on each other's internal details. That makes the system easier to build, test, scale, and maintain. Integration needs careful planning too, using standard interfaces like APIs and common data formats.
Building blocks, basically. And when you're writing the code for these blocks, any best practices to follow?
Oh, loads. Good coding hygiene is essential. Clear organization project structure, meaningful names for variables and functions, readability, use comments wisely, format code consistently. Documentation is vital, explaining what the code does and why.
Not just for others, but for your future self.
Exactly. Refactoring code regularly to improve its design. Optimizing critical sections for performance, but only after profiling to see where the bottlenecks really are. Security is paramount, validating inputs, handling errors gracefully, secure logging, maybe encryption. Robust error handling using try, except blocks, or similar constructs is a must.
Building reliable, understandable code. And testing. You can't just hope it works, right?
Absolutely not. Rigorous testing is non-negotiable. Unit testing checks individual functions or small pieces of code in isolation. Frameworks like PyTest in Python or JUnit in Java help automate this. You need good test coverage.
Testing most of the code paths.
Ideally, yes. Integration testing checks if different modules work together correctly. And then there's backtesting, which we'll get to. Debugging is also a skill, using debuggers, analyzing logs, tracing errors. Comprehensive logging is crucial not just for debugging, but also for monitoring and compliance.
Giving a trail of what happened. What about when multiple people are working on this?
Version control is essential. Systems like Git track every change to the code, allow branching for developing new features without breaking the main code, and help merge changes from multiple developers.
Git is pretty standard now.
Very standard. Branching strategies like Git Flow help manage the development process. Continuous integration, CI tools like Jenkins or Travis CI, automatically build and test the code every time changes are committed. Collaboration platforms like GitHub or GitLab host the code repositories, manage issues, facilitate code reviews. It's all about teamwork and maintaining code quality.
Okay, so you've built it, tested it, it's version controlled. How do you get it running live? Deployment.
Deployment needs to be carefully managed, often involves automated deployment pipelines. You might have stages deployed to a testing environment, then a staging environment that mimics production, then finally to the live production servers.
Minimizing risk during rollout.
Exactly. Using infrastructure as code tools, like Terraform, and configuration management tools, like Ansible, helps automate setting up the servers and environments consistently. Containerization with Docker makes packaging and deploying applications easier. Orchestration tools like Kubernetes manage those containers at scale. Techniques like rolling updates, canary releases, or blue-green deployments allow you to release updates gradually with minimal downtime or risk.
Lots of options for safe deployment. And once it's running, it's not set it and forget it, is it? Maintenance.
Definitely not. You need constant monitoring of system health, CPU usage, memory, network latency, application performance. Alerting systems like Prometheus with Grafana notify you if metrics go outside normal bounds. Incident management processes are needed for when things inevitably go wrong, how to respond, communicate, find the root cause, and learn from it, postmortems. Plus, ongoing software updates, patching security vulnerabilities, maintaining the underlying infrastructure. It's a continuous effort.
A living system that needs constant care. Okay, you mentioned backtesting earlier. Before risking real money, you need to simulate how the strategy would have performed historically. How do you build a good backtester?
A good backtesting environment needs several key parts. A data handler to load and feed historical market data. The strategy logic itself. A realistic model for transaction costs, brokerage fees, slippage, market impact.
Slippage, the difference between the price you expected and the price you actually got.
Exactly. Especially important for larger orders or fast markets. The backtester also needs portfolio management logic to track positions, cash, equity. And finally, calculation of performance metrics. Getting the historical data right, cleaning it, adjusting for corporate actions like splits is crucial. And simulating market conditions realistically is the hard part.
Making it act like the real world.
As much as possible. Modeling how orders actually get filled, maybe partially. The bid-ask spread, price gaps overnight. If your simulation is too simplistic, the results won't mean much.
Garbage in, garbage out again.
Yeah.
So you run the simulation. How do you judge if the strategy is any good? Performance evaluation.
You look at a whole suite of metrics. Return metrics are obvious. Total profit, annualized return. But you need to compare that to risk.
Risk-adjusted return.
Right. Risk metrics include volatility, standard deviation of returns, drawdown analysis, especially the maximum drawdown, which is the biggest peak-to-trough drop in equity. How long did it take to recover from that drawdown?
Ouch. Yeah, knowing the worst potential pain is important.
Very. Then you combine these into risk-adjusted metrics. The Sharpe ratio is the classic 1 excess return over the risk-free rate divided by volatility. Sortino ratio is similar, but only penalizes downside volatility.
Okay.
What else? Win rate?
Win rate, loss rate, average win size versus average loss size, profit factor, gross profits divided by gross losses, expectancy. These tell you about the consistency and character of the strategy. Turnover rate tells you how actively it trades, which impacts costs. A whole dashboard of numbers to understand performance. Now, backtesting sounds great, but you hear about pitfalls. Biases.
Oh yes, backtesting is full of potential traps. Look-ahead bias is a common one, accidentally using information in your simulation that wouldn't have actually been available at that time.
Like using tomorrow's closing price to make a decision today.
Exactly. Easy mistake to make if you're not careful with your data handling. Survivorship bias is another big one, only testing on assets that exist today, ignoring companies that went bankrupt or assets that were delisted in the past. Your historical universe is skewed.
So your results look better than they would have been in reality.
Right. Data snooping bias or overfitting is huge. If you test hundreds of variations of a strategy on the same data, you're bound to find one that looks good just by random chance. It's fitted to the noise, not a real edge.
Curve fitting.
Curve fitting, exactly. Selection bias in choosing what to test. And simply ignoring or underestimating transaction costs can make a losing strategy look profitable. You have to avoid these biases for the results to be meaningful.
How do you avoid them? What controls can you put in place?
Crucially, use out-of-sample testing. Train or develop your strategy on one period of historical data, the in-sample period, and then test its performance on a different period it hasn't seen before, the out-of-sample period.
Seeing if it generalizes.
Yes. Walk-forward analysis is a more advanced version where you repeatedly optimize on a rolling window of past data and test on the next period. Cross-validation techniques also help. Parameter stability testing, see if small changes to your rules drastically change results. Only pursue strategies that make some kind of economic sense, not just random correlations. Penalize complexity, and perform statistical significance tests on your results.
Rigorous validation. Okay, if a strategy looks promising after careful backtesting, people often try to optimize it, right? Tweak the parameters.
Yes, optimization is common, but needs to be done carefully to avoid overfitting. Parameter grid search is simple. Just try lots of different combinations of your input parameters, like moving average lengths, and see which combination performed best historically.
Brute force testing
can be computationally expensive. Genetic algorithms are a more sophisticated search method inspired by evolution that can explore the parameter space more efficiently. Walk-forward optimization, as mentioned, optimizes parameters on rolling windows, adapting to changing markets. Sensitivity analysis is also important. See how sensitive your results are to small changes in parameters. You want robustness.
A strategy that isn't too fragile. How do you specifically check for overfitting during optimization?
Compare that in-sample versus out-of-sample performance again. If it looks amazing in-sample but falls apart out-of-sample, that's a huge red flag for overfitting. Visual inspection of the equity curve can help. Simpler models are generally less prone to overfitting. Cross-validation gives a more robust estimate of performance. Stress testing, seeing how it performs under simulated extreme market conditions, also checks robustness.
Okay, so you've done all this work. How do you present the results clearly? Reporting.
Good reporting is essential. Generate clear performance reports summarizing the key return and risk metrics. Visualizations are powerful equity curves showing the growth of capital over time, drawdown charts highlighting the painful periods, maybe histograms of returns or heat maps of parameter performance. Tailor the report to the audience. Be balanced. Report the good and the bad. Document all your assumptions clearly. The goal is transparency and actionable insights.
Makes sense. Okay, risk is clearly a huge theme throughout. Let's focus specifically on risk management and also the regulatory side.
Yeah.
What are the main types of financial risk algos face?
We've touched on some. Market risk is the big one, prices moving against you. Credit risk, your counterparty defaulting. Liquidity risk, not being able to get your trade done at a decent price or at all. Operational risk, things breaking, system failures, human error. And regulatory risk rules changing or failing to comply with existing rules.
And measuring these.
Yeah.
Quantifying the danger.
Quantitative measures help. Volatility, we mentioned. Value at risk, VAR, estimates the maximum potential loss over a given time period at a certain confidence level. Expected shortfall, or CVR, goes further and estimates the average loss if you exceed the VAR threshold. Beta measures sensitivity to overall market movements. Drawdown analysis quantifies historical losses.
So putting numbers on the potential pain, how do you actively manage these risks?
Various techniques. Mitigation strategies include using stop-loss orders to automatically cut losses, setting position size limits so no single trade can blow you up, maybe scaling trade size based on market volatility, controlling leverage carefully, diversification across different assets or strategies, hedging specific risks using derivatives.
Tools to limit the damage.
Right. And continuous risk monitoring is vital. Real-time tracking of positions, exposures, risk metrics, setting threshold alerts if limits are approached, running stress tests regularly, defining clear risk limits, upfront maximum position size, maximum loss per day week, maximum overall exposure. These need to be strictly enforced.
Discipline again. What about the regulatory environment? Is it complex?
Oh yeah. It's a global patchwork, though, with efforts to harmonize. Key regulations like MiFID II in Europe and Dodd-Frank or Regulation NMS in the US have specific rules for algorithmic trading. Things covering testing requirements, risk controls, order flagging, record keeping. Data protection laws like GDPR and CCPA are relevant too. Market abuse regulations targeting manipulation or insider trading are strictly enforced. Reporting obligations to regulators are significant.
Lots to keep track of.
Definitely. And ethical considerations are important too, ensuring fair access to markets, avoiding manipulative strategies, being transparent, taking responsibility for errors, watching out for algorithmic bias. It's not just about following the letter of the law.
Doing the right thing. How do firms ensure compliance?
They need robust internal compliance procedures, often automated monitoring systems looking for suspicious activity or rule breaches, fulfilling regulatory reporting requirements accurately and on time, undergoing internal and external compliance audits. Detailed record keeping is usually mandated.
And what if the worst happens? Systems go down, data center floods, business continuity.
Essential. Having a well-defined disaster recovery plan, DRP. This includes backup trading sites, regular data backups stored securely off-site, clear recovery procedures, and regular testing of the plan. Redundancy is key: backup servers, redundant network connections, automatic failover systems. And robust cybersecurity measures are part of this too: firewalls, intrusion detection, encryption, incident response plans for hacks or breaches. You have to plan for failure.
Hope for the best, plan for the worst. Okay, let's drill down into execution specifically. Getting the trades done well. Order types again.
Beyond the basic market, limit, stop orders, algos use more advanced types. Iceberg orders hide the true size. Fill or kill demands immediate, full execution or cancellation. Immediate or cancel takes what it can get instantly and cancels the rest. Orders can have time limits like day or good till canceled. Trailing stops adjust automatically. The choice depends on the strategy and market conditions.
Choosing the right tool for the job. And where do these orders go? Venues.
Exchanges, ECNs, ATSs, including dark pools, OTC markets. Each has pros and cons regarding transparency, speed, cost, potential for price impact, counterparty risk, especially OTC. Algos need to understand this landscape.
And connecting to them. FIX protocol.
FX is the workhorse standard for order routing and execution messages between brokers, institutions, and exchanges. Some venues might have their own faster proprietary protocols too. Connectivity can be via the internet, dedicated leased lines for more reliability, or co-location for the lowest latency. Latency is always a consideration.
How does the algorithm decide how to work a large order? Execution algorithms.
Yes, execution algos are designed to minimize the costs and market impact of filling an order, especially a large one. Schedule-based algos like TWAP, time-weighted average price, or VWAP, volume-weighted average price, spread the order out evenly over time or according to historical volume pattern.
Trying to blend in.
Exactly. Liquidity-seeking algorithms are more opportunistic, trying to find hidden pockets of liquidity or crossing the spread only when favorable. Some adapt in real time based on market signals or use machine learning. The goal is often best execution.
Getting the best possible result for the order. Transaction costs are a big part of that. What are the components?
Several parts. Explicit costs are brokerage commissions, exchange fees, regulatory fees. Implicit costs are the killer: slippage, price moving against you while you trade, and market impact, your own order moving the price. There's also opportunity cost if your order doesn't get filled when you wanted it to.
How do you minimize those?
By choosing the right execution algorithm, deciding how aggressively to trade, potentially breaking up large orders, choosing the right venue. Post-trade cost analysis, TCA, helps you measure these costs and refine your execution strategies.
Learning from past trades. Managing all these orders requires systems, right?
OMS. Order management systems, OMS, are central hubs. They handle order entry, routing to different venues, tracking order status, receiving execution reports. They often integrate with risk management systems and back-office systems for clearing and settlement. They also need to support regulatory compliance with audit trails and reporting features.
A control center for orders.
Yeah.
And routing orders intelligently. Smart order routing.
SRR becomes crucial because markets are fragmented. The same stock might trade on multiple exchanges and ECNs simultaneously. An SRR algorithm constantly monitors prices and liquidity across all these venues and routes parts of your order to wherever it thinks it will get the best fill right now, according to predefined rules. Best execution regulations often mandate using SRR or proving you have equivalent processes.
Finding the best price across all venues. Are there even more advanced techniques?
Yeah, things like trying to access hidden liquidity in dark pools intelligently. Adapting execution tactics dynamically based on real-time market volatility or news events. Applying machine learning to predict short-term price moves or market impact to optimize execution timing and placement. It's a constantly evolving area, especially as you look at challenges in less liquid emerging markets.
Always pushing for that extra edge in execution. Okay, looking forward now. The future of algorithmic trading. What are the big trends on the horizon? Blockchain and crypto.
Definitely a major area. Understanding blockchain technology, the major cryptocurrencies like Bitcoin and Ethereum, how decentralized exchanges, DEX, work. Algorithmic strategies are being applied here too, arbitrage between exchanges, trend following, market making, and crypto. The regulatory landscape is still evolving rapidly, though.
A new Wild West, maybe.
Yeah, perhaps a bit. Quantum computing is another potential game changer, though, further out.
Quantum, how would that apply?
Its potential power in solving complex optimization problems could revolutionize portfolio construction, risk management, even finding arbitrage opportunities currently hidden. It also poses a threat to current cryptography, which has implications for security. Still early days, but huge potential.
Mind-bending stuff. What about AI and robotics?
We'll likely see more truly autonomous trading systems powered by advanced AI. Robotic process automation, RPA, is already automating many back-office tasks in finance. The future might be more about human-machine collaboration, AI providing insights and decision support, humans overseeing and managing risk.
Augmented intelligence.
Exactly. And the data sources will keep expanding. More alternative and unstructured data, sensor data from the Internet of Things, more sophisticated satellite imagery analysis, maybe even analyzing voice data from earnings calls automatically.
Even more data to feed the algorithms. What are the bigger picture implications? Societal impact.
Important questions there. What does increasing automation mean for market stability? Does it increase fragility? Issues of fairness and equal access, potential job displacement in traditional trading rules, and regulators constantly grappling with how to oversee these rapidly evolving technologies, ethical considerations become even more critical.
Big challenges. What skills will be needed for people working in this field in the future?
It's increasingly interdisciplinary, strong data science skills, programming ability, quantitative finance knowledge, understanding the regulatory environment, and crucially, a mindset of continuous learning and adaptation. The field changes so fast.
Got to keep learning. Any final thoughts on where things are heading? Success stories? Lessons learned?
Well, firms like Renaissance Technologies and 2 Sigma have shown the incredible potential of quantitative and algorithmic approaches. But events like the flash crash or the Knight Capital debacle are stark reminders of the risks. The future likely holds more automation, even more data, possibly breakthroughs from quantum, ongoing regulatory evolution, and an ever-increasing focus on cybersecurity.
Fascinating. So to wrap up this deep dive, what are the main takeaways?
Algorithmic trading is really this blend of finance, technology, and quantitative analysis. It's transformed markets, bringing efficiency and liquidity, but also new complexities and risks like technical failures and potential volatility amplification. It's not static. It demands constant innovation, rigorous risk management, and ongoing learning.
Definitely a dynamic field. And maybe a final thought for you, the listener. As algorithms play an ever larger role, really consider that balance, the efficiency gains versus the potential risks. What does this relentless drive towards automation truly mean for how markets work, for investment strategies, and ultimately for the stability of our global financial system? Something to mull over. Thanks for joining us on the Deep Dive.